Good evening, everyone. Welcome to Market Monday. My name's Dave Huber, and I am part of the Tradeway team. I'm here to help you get a handle on what's going on in the market today. Some of you have already been watching the market for a little bit. Maybe you've been trading some stocks. Maybe you've seen some opportunities in the market. Others are brand new. You're brand new to the whole Market Monday idea, and you're like, I have no clue what I'm looking at. Can you make it make sense to me? So I want to help make it make sense today. What we're going to do is we're going to look at what's driving the market and what can we expect the market to do from here on out. So if you are brand new, thank you for joining us. Drop us a comment in the comment section. If you've never been a part of Market Monday, let us know you're new. Let us know your thoughts. We'd like to know how you like this. But let's get into it. Let's talk about what's moving the market. There's one great big story here, and it's always the same. It's always the same. What is that story? It is inflation. Inflation. Now, you guys probably know what inflation is all about because you're experiencing it in your everyday lives. You've got groceries going up in price. You've got gas going up in price. You've got just the general cost of living is going up in price. And that is kind of the thing that is driving the market. See, as inflation gets worse, which means the value of your money goes down, what's happening is there's too much supply in the economy, too much money in the economy. You know, how is there too much money? That seems like it'd be a good thing. Well, think of it like this. If there's a whole lot of dollars chasing too few products, then the price of those products have to go up because there's fewer products for people to buy. Supply chain problems are one of the things that you're probably familiar with. Back during COVID, when we had supply chain problems, you experienced too few products. Well, there was a a drop in how much supply we had, which meant the dollars that we had were chasing too few products. Now what's happening is because of all the money we've printed in stimulus to overcome the problems of COVID. Now, even though the supply chain is catching up and all of a sudden we've got more products to buy, now there's too much money in the system. It's just created quite a mess. And so what the Federal Reserve is trying to do, you've probably seen it in the news, they are trying to get on top of inflation. You say, well, how do they get on top of inflation? Well, they reduce the amount of money that is available to the general public. What they do is they raise interest rates, which is the cost of borrowing money. So when it costs more to borrow money, then the money becomes less available because people don't go borrow as much. So what can we expect from here on out? If they are trying to reduce the amount of money supply that is in the market so that inflation will start to come down, are we beginning to see the end? Are we beginning to finally see that, okay, maybe the stock market can start going up again? Maybe we can start seeing prices come down of gas and groceries and things of that nature. Well, the world system would have you believe that we've been on top of it the whole time. The world system would have you believe that we're almost at the end. But are we really? That's what we're going to discuss today in today's Market Monday. Here's how we know. We have an inflation target goal. In other words, there is an amount of inflation that is generally considered healthy. It's 1 to 2%. Basically, we're saying 2%. Here in America, the Federal Reserve, which is our central bank, they're saying we would like to see inflation at 2%. If it's higher than that, we have a problem. It's beginning to cost too much for people to go out and buy their groceries, buy their gas, just have general cost of living, pay their electric bills, their water bills. It's all going up in price. And we want to see inflation come down so that they don't feel that pain so much anymore. So we need to get inflation down to 2%. You say, well, what's it at? Well, after the pandemic, hit and we printed all that money, we saw inflation spike as high as over 8%. I mean, it went way high. And that's 4 times what we wanted it. So think about just how crazy that is. That's pretty high. What we want is we want to see it come down to 2. So where are we? Well, good news for you. We just had an update from the Federal Reserve that was reporting on the numbers, reporting on inflation, reporting on their plans moving forward for the market and the economy as a whole. Remember, they are attempting to bring inflation down by increasing the cost of borrowing money, otherwise known as interest rates. So they're going to increase interest rates. Well, what does that mean for the market? Well, when interest rates go up, the cost of borrowing money goes up, which means if you're an investor, you can make money by loaning money to people, right? You can actually make a higher return if the cost of borrowing has gone up. So if the cost of borrowing goes up, then that becomes a very attractive investment for investors. And they begin to look at the tumultuous situation in the stock market, stocks going up and going down and going crazy. And they go, wow, this is getting really kind of messy and it's hard to make returns in the market right now. So they pull their money out of stocks and they put their money into things like bonds, which is where they invest in loaning money out to other people or organizations or governments. And so when the cost of borrowing money goes up, you often see the stock market take a hit and go down. So the further up the Federal Reserve raises those interest rates, the more they say, all right, it costs more to borrow money. And remember, they're doing that to get on top of inflation. The more they do that, the more we can expect to see the stock market come down. So they've been doing this for over a year. They've been raising the interest rates, which is why all last year, 2022, we saw the stock market coming down. We saw stocks decreasing in value. Now, people are saying, okay, well, we've had a little bit of a rally in the market. The market's kind of coming up. Does that mean it's over? Well, what's happening is all the major banks and all the financial advisors, they're all trying to keep you from pulling your money out of their financial services, because they know that in a recession, people tend to do that. They tend to get real protective of their money. They don't want it invested in stocks when the market's going down. So they start telling you it's almost over. They're almost at their goal. It looks like they can stop raising interest rates. They start telling you that so that you'll think, okay, if it's almost over, I want my money in the market so that as the stocks start rising, I can make a return. But what if it's not over? What if it's not over? What if the Federal Reserve is going to continue raising interest rates? If they do that, the stocks will fall. And if you keep your money in long-term investments, mutual funds, things of that nature, then you'll see the stocks coming down in price and you'll take a hit. You won't make a return. You'll actually have an expense, but you'll still be paying management fees to those financial services companies. So what do? We just get informed. We look at the facts for ourselves. So what I'm going to do is I'm going to pull up the minutes from the Federal Reserve meeting that happened, I believe it's last Friday. And we're going to just look at what the Federal Reserve is saying their plan is right now. Now, keep in mind, just because stocks are going down doesn't mean there's not an opportunity to make money in the stock market. It's just you're probably not going to make a return in the stock market by buying and holding a stock when the market is coming down. Instead, you can make money in various other strategies. Buying put options, which is like insurance for stocks. Some of you have learned about this. If you've been to some of our classes, we can show you how to chase returns in the market as the market's crashing. There's actually a huge opportunity to make money in the stock market as the stocks are coming down. But what do we do, right? Like, how do we know if the stocks are going to come down? Well, we look to see what the Federal Reserve is actually saying. So I'm going to pull that up real quick. I'm just going to share my screen because I've got the notes here. Let me come right here to share screen. And there it is. Here are the notes. This is actually a word for word quote from the Federal Reserve Chair Jerome Powell. Okay, so this was from August 25th. That's 3 days ago. So Sunday, Saturday, it'd be Friday. Friday is when this happened. And I'm not going to read the entire thing, but I'm going to give you an idea of what he said. So we'll start off at the beginning. He says, at last year's Jackson Hole Symposium, I delivered a brief, direct message. My remarks this year will be a bit longer, but the message is the same. Here's his message. It is the Fed's job to bring inflation down to our 2% goal, and we will do so. I like the way he says that. It's very clear cut. We are resolved to get to 2%. He makes no mistake about, guys, don't get this twisted. We're going for 2%. If we're not at 2%, we are not done. That's literally what he's saying here. He says, we have tightened policy significantly over the past year. What does that mean? That means they've raised interest rates over the past year, which tightens the ability for people to borrow money because it costs more to borrow money. So it's tightening policy. That's what that is. Monetary policy has been tightened. Although inflation has moved down from its peak, which is a welcome development, it remains too high. Just said it right there, guys. Inflation is still too high, which means we're not at 2% yet. We are prepared to raise rates further if appropriate. So in other words, we're waiting to see if we need to raise them further, but we are ready to if we indeed decide we need to. That does not sound like a Federal Reserve that is excited about reducing interest rates. And that's, if they are starting to talk about maybe it's time to reduce interest rates, then you can start to see the market really take off. That's not the words coming out of their mouths at this present time, guys. It's all about, we are still in the mindset of tightening policy. Okay, so let's skip on down a little bit. He talks a little bit about the decline in inflation so far. Let's bring that out just real quick because that's going to be important. He says, by the time the Federal Open Market Committee, you might have heard of the FOMC, that's what that is. The Federal Market Committee raised the policy rate in March 2022. It was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy. Let me make that make sense. In other words, it was very clear that we were battling the problems caused by COVID, supply chain problems, and that the only way we were going to get this problem fixed was those supply chains start freeing themselves up, because that would help with inflation. That would make inflation start to come down. But at the same time, we'd also have to raise interest rates. So we planned on both. We planned on the supply chain problems coming down and starting to normalize, and people starting to be able to get their shipments in from Amazon and from foreign countries into our ports. We had lots of ships that weren't coming into port because of COVID. So he's saying once everybody starts getting their shipments to come in and we don't have supply chain problems anymore, that will help inflation. But we will also have to fight inflation by raising interest rates, because that wasn't the only reason we had inflation. It wasn't just because of supply problems. It was also because we printed a lot of money, right? And so here's what he says. We knew this going in. We were going to have the supply chain problems fixed. We were going to have our interest rates raised. Guess what, guys? The supply chain problems have mostly normalized. So those are fixed, but we're still not at our 2% goal, which means we still have to raise interest rates. All right. So then he says, on a 12-month basis, U.S. total or headline PCE inflation peaked at 7% in June 2022. By the way, that number is not the number that we have been focused on as a country when we look at our mainstream media. They've been focusing on CPI. CPI is Consumer Price Index, and it is not the number that the Fed goes by. CPI was spiked really high, and then it started coming down quite a bit. And the liberal media, I say the liberal media, even conservative media, guys, it was liberal and conservative media. Everybody in the media was saying, look, inflation's coming down and CPI is starting to look good. We're getting really close to about that almost 2%. We're just above 2. We're getting down to the low 3s and stuff. So that's what everyone's been saying. But if you looked at the numbers that the Federal Reserve actually goes by, which is the personal consumption expenditures inflation, we didn't get down to 2% here. These are the numbers they're going by. PCE is the number that they're looking at. And they did get it down to 3.3% as of July. But guys, that's July, following a trajectory roughly in line with global trends. The effects of Russia's war against Ukraine have been a primary driver of the changes in headline inflation around the world since 2022. Headline inflation is what households and businesses experience most directly. That's why they focus in on this number primarily. When you look at CPI, it's actually only focused in on urban areas. PCE kind of covers every household in the nation and all the businesses too. All right, so he says, I will focus on core PCE inflation. Right there, look, I will focus on core PCE inflation, which means when the media tells you CPI is coming down, that's meaningless to the Federal Reserve, who's in charge of raising interest rates. He's watching PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome, but 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. Was he saying? We're going in the right direction, but we're not at 2% yet. And if we're not at 2% yet, we're probably going to have to keep raising interest rates. Now, you can go in and I'll share, you can actually go to federalreserve.gov and read all of this if you'd like to get in all the nitty gritty yourself. But I'm going to share the conclusion with you. Here's the conclusion of all the economic growth that he's seeing in the labor market. He basically is saying that because of uncertainty and risk management along the path forward, 2% is and will remain our inflation target. So we're not there yet. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. Notice he says we are committed to achieving and sustaining a stance of monetary policy. In other words, we have not achieved the restrictiveness enough yet. This really sounds like he's planning on raising interest rates a little bit more. Now, I know we're going to wait and see what kind of numbers we get because there's a little bit of a lag between when they raise interest rates and when the inflation numbers start to come down. It takes a little bit of time for the effects to be felt across an economy that's truly connected globally, but we're looking at a country size scale here, so a national scale. So when we're looking at this, we say, okay, as is often the case, we are navigating by the stars under cloudy skies. In other words, we really don't know what's going to happen. We have to wait and see. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlooks of risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. So what does that mean? There's a chance we just stay where we are and not increase interest rates, but we can't say that yet. So we're going to be ready to increase them if we need to, or keep them where they are if we need to. Neither one of those has anything to do with lowering interest rates. So what does that mean? We are not done getting to 2% yet, which means we're not done seeing the market crash. I really don't think we're done with that yet, because as we continue to raise interest rates, the market will continue to come down. How do we know? Well, let's take a look at the S&P 500 dividend yield. This is what's happening in the returns that people get just by holding a stock for a long time and receiving a dividend. So in other words, a lot of blue chip stocks, the more expensive stocks, they will pay you a little bit of money sometimes quarterly, sometimes annually. They'll pay a little bit of money for you to buy and hold their stock. And the yield, the average yield or the average return someone gets back in about December or September of 2022, the average return someone would get would be 1.82%. Now, if you've been to a Tradeway course or a Trade Surge class, you've probably learned how powerful it can be to get a 2% return on your investment. That can actually be a pretty big deal over time because it compounds. But here's the reality, guys. Those returns, just by holding a stock, they are declining steadily. They're going down. So in other words, people who go and just buy a stock and hold it long-term to make a return, they're not making huge returns. Now, there are ways to make great returns in stocks still. You can still trade them more short-term as opposed to long-term. But if all you're doing is buying and holding, your returns are diminishing. And so if those returns are diminishing, those type of investors that like to just be kind of hands-off and they just buy and they hold, instead of buying and holding a stock, they're going to start looking at that bond market and saying, you know, the cost of borrowing money is going up. I could just take my money out of stocks and put them over there in the bond market and make a return on bonds. And so what is that going to do? Well, it's going to present a real awesome opportunity for our stock trading students to capitalize on a downward move in the market. In other words, it's going to create an opportunity to make money when the market crashes. That's cool. But for those of you who just want to buy and hold a stock, buying and holding stocks at this time is not very wise. We're looking more and more like that's going to have a diminishing return. And so when that happens, the stock market typically gets a sell-off. People go, I don't want to buy and hold a stock anymore. I'm going to sell my stocks and go buy bonds, which can further create downward pressure on the stock market. That means we could find ourselves in a downward spiral in the market, which we've kind of been expecting for quite some time here at Tradeway. Oh, looky there. I say here are the returns. I thought I shared this, but it didn't share. Let me show that screen one more time because it didn't actually share the screen the way I thought it did. I want to show you those diminishing returns. So let's go here. Sorry about that, guys. I didn't share my screen properly. Here are the diminishing returns. Even just from last year, we were at 1.82% in September. We are now down to 1.54%. If you look at a 5-year chart, you're seeing that it's on the decline. It had been coming up during 2022. There was lots of buying, but as we started tightening our monetary policy and we started raising interest rates, that started to taper off in 2022 and then started declining. It's going to continue to decline. There is a little bit of a lag, notice, because we were raising interest rates in here. It's going to continue to decline as we continue to raise interest rates. So here are the diminishing returns of just buying and holding a stock. It's kind of, they got this downward trend going on right now. So what does that mean for those of us who are looking to make returns in the stock market? Well, it means there could be an opportunity to make a return in the stock market by doing short-term put strategies. It doesn't have to be super short-term. It can even be mid-term. In fact, if we think we're going to see the market crash for some time, you could go longer term. Some people are looking at longer-term put option strategies. They're looking at how can I make money when the market crashes over the next year, right? So let's just take a look in the market real quick, and we'll get a feel for what we're seeing in the market. Here is a chart that's of a particular stock. That's not what I'm looking at. I want to look at the S&P. So here's the S&P, and I'm going to get rid of some of these old lines here and just kind of give you guys an idea of what we're looking at. I'm going to zoom out just a little bit, and we're going to discuss some of the moves we've been seeing in the market. I'm going to zoom out quite a bit so we can see. In 2022, we were getting a good, healthy, recessionary looking motion in the market. And this is what we had been waiting for. We really wanted to see more of this. We got a very short-lived bear market here. And the reason is people got really excited about artificial intelligence. This is right around the time that artificial intelligence really hit the mainstream, and people got super excited about it. And they said, hey, this is the thing that's going to drive a new bull market. When there is a new bull market, there is always some new leader of the bull market. So I understand why a lot of people just assumed we're going to get into a new bull because of this. It's going to be a good long-term uptrend because we have something new, which is artificial intelligence. The problem, though, is that you've got a couple of things working against this. Typically, when we have a new bull market, we have something new leading the way, some kind of new industry leader, which AI would fit that bill. But you also have interest rates being cut by the Federal Reserve. Usually you have interest rates going down, not up. So that doesn't really fit the textbook definition of a new bull market. So that's not really happening. And yet we got this up move. We do have some bullish market tone. And at Tradeway, we've been saying we are short-term bullish and long-term bearish. Part of the reason why we're long-term bearish is because we know we're not done raising interest rates, and there's not a broader adoption in the overall market. We're not seeing people flood the market with cash and say, all right, now I'm going to go buy up a whole bunch of stocks. We saw some frenzy over the AI stocks, artificial intelligence, but that's about it. We didn't see anybody else go, okay, let's buy some of these other stocks. It was just in the NASDAQ. The NASDAQ really pulled everything up with it. Just in the tech stocks, the NASDAQ tends to be tech heavy. They are tracking mostly tech stocks. And so when you see artificial intelligence stocks take off, you'll see the NASDAQ is moving up. And you saw that it moved up so much that really the overall market kind of stayed. People didn't continue to sell off because they're like, hey, maybe this is the new thing. Maybe we're in a new bull market. But we're also starting to see some shaken confidence in this up move. And I'm going to zoom in so you guys can see this a little bit better. But right in here, we went from a very strong uptrend to now we're starting to see it taper off a little bit. We've got at least what we call a correction, right? This is a correction now. We're starting to get some downward movement. We broke down out of the little trend up that we were seeing, and the market's correcting. But it's not just correcting. It's also forming what we call a head and shoulders. This is a very bearish pattern here. So if you've never heard what head and shoulders is, you want to take some of our classes. We've got some really cool courses that talk about the different patterns that the market makes and what typically follows after these patterns. See, these patterns are really just telling us the underlying psychology behind the market. And what we're seeing with this head and shoulders is that the psychology is not as bullish as the mainstream media would have you believe. The mainstream media is often working alongside with Wall Street to try and keep you to stay invested in your Wall Street products, stay in your mutual funds, stay in your financial services, because we want to hold on to your money, and we want to still control your long-term investments in your retirement accounts and things of that nature, because we get paid our management fees when we do that, right? That's what Wall Street is all about. They want to get paid those management fees. And so even in a recession, they don't want you to pull your money out, because that means they won't be getting as many management fees. And so what we're seeing here is that while the mainstream media and Wall Street wants you to believe that we are in a new bull market, this thing is going to scream up, it's not as strong of a bull market as they would have you believe. So there is some room for this to maybe continue down. And the pattern that we see here, here's a shoulder, here's the head, and it's starting to form a second shoulder. Often when this happens, what we'll see is the market break down below this point. And if we see that on higher volume, it's going to get real bearish real fast. We're going to see the stocks just crash. Now, this is, of course, we're just looking at the S&P 500. If you don't know what that is, that's the Standard & Poor's 500. It's an index that tracks 500 large cap stocks. What do you mean large cap? Well, it means the most expensive stocks, right? In other words, it's tracking all the leaders in the market. It's tracking like the major players in the market, and everybody else tends to follow these major players. So when we track the S&P 500 and we see that these 500 stocks collectively are showing a bearish pattern, then we say, okay, the market may be getting ready to turn bearish again. And so some of the financial services that Tradeway provides actually goes and capitalizes on bearish moves. Some of those who are in Amped, they are enjoying the opportunity to make a return off a bearish move. And so if you want to know more about that, just give us a holler. Go to support@tradeway.com. You can email us there, ask us about Amped. If you want to know more about what's going on in this market, though, you really need to get into some of our courses. You need to get into maybe step one, start your journey. If you've not been to a Tradeway class of any kind, check us out. I think you'll really enjoy it. I'm not going to give you like a sign up here or anything like that today. I do have something for you to register for, but it's a free thing that I think you guys will really enjoy, because I really think it will give you an idea of what Tradeway is truly all about. We help people with their finances, with their investments, I should say. We help them with their investments and understanding what the market is doing. But we also try to help on a deeper level, because when it comes to your investments, the name of the game is staying mentally strong, right? Like, it's all about staying mentally strong, because your emotions can get the better of you and you can get all caught up in AI stocks and go and buy up a whole bunch of stocks at the wrong time. And then the market crashes and you take it an expense. You can find yourself holding on to stocks too long and experiencing what many of you may have experienced back in 2008, where the market started crashing and your retirement accounts start going down. Or back in the 2000, for those of you who've been in the market for quite some time, if you remember the dot-com bubble burst, that was really hard on people's retirements. And what happens is we just don't have the right mentality to tackle the investment world. And so at Tradeway, we try to help build the mentality for tackling the investment world. So we show you not only like what to do and how to do it and why to do it, but we also try to help build the trader. We help build the inner man. And we do that through biblical principles. And so one of the things that I want to share with you guys today, now that we've kind of looked at what's driving the market, I want to share with you one of the ways that we help build the inner man. Oh, Kelly, thanks for saying hi on here. I was reading that September is historically the lowest market month of the year. Yeah, what happens, Kelly, is it's kind of right towards the end of the summer, and we've experienced summer doldrums, and so there's a lack of participation in the market during the summer. And this is kind of at the tail end of the summer. And so a lot of people who were participating in the market during that time, they get burnt out on stocks, and they go, all right, I'm done with it too. And there's a little bit more of a sell-off in September. So that can happen, where historically September can be a pretty low month. And we're about to be in September. So isn't that interesting? You may see a sell-off just for that reason alone. But that's not the only reason, because we also have the interest rates going up as well, and that's going to have a downward pressure on the market. So as you can see, we try to get you prepared for what's going on in the market. And I've got a question here. This is great. Hi, Jackie. What does it mean when market time is going from neutral to positive? I think you mean market tone. That's a great question, Jackie. Essentially what that means is when the overall market, which we refer to as the S&P 500, right? So the S&P 500, when we see that going from kind of a sideways motion, which we've been seeing recently, to an upwards motion, which was prior to this. See how this was sideways? We had a little bit of an upwards motion here. Right in before that, let's see, let me see what month that was. Right in here, we had a sideways or neutral market tone. See, it was going sideways. It means it doesn't really have a move going up or a move going decidedly down. It kind of gets stuck between a couple of price points. We call this a rolling action. in this particular scenario, it's on the market, but you can see stocks that are rolling stocks. You'll hear us talk about that at Tradeway quite a bit. And so a neutral market tone means the market has been moving sideways. And then it changed for a little while and it turned into a positive market tone, which meant it was moving up. If you hear a negative market tone, that means it's going to start moving down. So right now, one might say we're kind of in a neutral zone again. We're kind of moving up and down here. But I suspect, especially with this head and shoulders action going on here, we may see a negative market tone coming up pretty soon. So great question. I hope that makes it a little bit clearer for you there, Jackie. If you want to learn more and if you want to get some coaching on this and really experience a little bit more of what it's like to be able to ask these questions and get a better understanding of the market, then you definitely want to check out some of our education. Just go to Tradeway.com and check out our next live event that's coming up. That's not what I want to share with you first. First, I want to give you something extra for free, something that will show you what we're really all about, which is building the inner man, right? Building the trader so that the trading can be built as well. And so I want to share with you, let's see, I've got a link that I can share here. Where is that link? Here it is. Okay. Oh, that's not the right link. Let me get it. I've got it in a text here from one of our staff. There it is. Okay, I found it. I'll put this in the comment section for you guys. Oh, I already had it there. Okay. So this link is a way to go register for a free event. And this is called the Mindset Mastery event. It's something that I do with my good friend Blair Nightingale. And it's all about just building the inner man. We don't really even talk that much about stock trading in this thing, but it's about getting the mindset right so that when you go to tackle anything in life, family, friendships, a walk of faith, finances, right? Like any area of life that you want breakthrough in, our topic happens to currently be breakthrough. We're actually discussing breakthrough. We did a breakthrough topic last month on this, and we talked about the purpose of pain. We're going to be continuing the discussion on breakthrough. How do we achieve breakthrough in any area of life, including finances, through proper mindset? And so we're going to be doing that. When is that? I think that is September 5th at 11 a.m. September 5th at 11 a.m. You guys are going to love this. It's a really awesome, just free thing for you guys to take advantage of. And you'll see what we're really, truly all about. It's all about honoring and glorifying God through faith and family and business. And then if you like what you see, you might want to come and start learning some real stock market knowledge from us as well. And so you'll have some opportunities to get into some of our stock trading courses when you do that. But thank you so much for being on this. We have one more question. I'll take this last question, then I got to wrap it up. But when you said the market tone was long-term bearish, how many months or is it years? Great question there, Jackie. I would say, when I say short-term, I mean next couple of months where, if I say short-term, maybe over the next few weeks to the next couple of months would be bullish. Although right now, I'm not saying it's bullish right now. I'm kind of saying it's neutral to possibly even bearish. When we say long-term, a bear market typically lasts 6 to 9 months. And so that will give you an idea. It can last longer than that, especially when the government starts trying to do bailouts and stimulus money and things of that nature like they did in 2008. So we would expect it to last maybe as long as a year, maybe more. So it can be prolonged by government meddling in things they shouldn't meddle in. So there you go. I mean, it could be more than a year, but you wouldn't want to just hold on to stocks through that year because you're just losing value the whole time. It'd be better to know how to learn when to get in and get out so you can cut the losses, let the market crash, get a discount on getting back in and experience truly life-changing returns. There's a potential for that in the next bull market. So hopefully that answers your question there, Jackie. Great questions. And Janet, thanks for saying hi. I'll say hi to my dad for you as well. Glad to see that you know Pop there. And it's my pleasure, Kelly. Thank you all for being a part of Market Monday. I hope you've enjoyed it. Hope you got a little bit of insight as to what to expect in the coming months. Now that we know that we've not yet hit the 2% target for inflation, we can expect that we will either keep the interest rates high or continue to raise them, which spells bad news for market. All right, the stock market could likely crash more. So now you have an idea of what to expect. I hope to see you in the Mindset Mastery course on September 5th. It's about a 1-hour thing, and we'll see you then. And then we'll see you in the market. Y'all take care and have a fantastic evening.